Good morning. I don't know if people are going to join or not, but I'll start the class. Mm. లేదు లేదు. Mm. చెప్పండి లేదు. Mm. లేదు లేదు. వాళ్ళు చెప్పారు. Mm. ఏదో విన్నారులే. Mm. సరే సరే. Mm. In the last class, I have started the problems about portfolio written. Beta coefficient, Markowitz model. Today I'll explain the beta coefficient. So with this information, we have to calculate the beta coefficient. Determine the return on securities by using the Sharpe's model. So risk-free return, they have given 6%, and the details of the returns on security and market is given. So return on security, for security we are indicating with Y, and market we are indicating with X. So return on securities, these are the returns for the securities, and these are the returns for the market. So we want to evaluate the risk on security by using Sharpe's model. So here, for Sharpe's model, what is the formula? The formula for the Sharpe's model is RP is equal to RF plus beta into RM plus E. So here first we need to calculate beta coefficient. So what is the formula for beta coefficient? N into summation xy minus summation x into summation y divided by n into summation x square minus summation x whole square. This is the formula. So here n into summation xy. So that's the reason we have evaluated summation xy and summation x and summation y. X square we need to calculate. So here after evaluating all these things, we got the summations of x, y, x square and xy. So simply we have to apply all these values in the formulas and we are going to get the beta. Beta is 1.38. If our beta is more than 1, then the whatever the securities and the returns are there are high risky securities. So after getting the beta, simply we are applying in the formula RF plus beta into RM plus C. Beta RF already in the problem they have given 6%. Beta, we have valued 1.38, written on market 11 plus error. So we got written on portfolio according to the Sharpe's model 21.18. Next, we are going to know about the capital effect pricing model. So here Sharpe dealt as well as he always deals with the market, which is more uncertain. So it may not give an accurate portfolio return. So that's the reason Markowitz and Sharpe together they developed an approach to know the risk and return of an individual securities with an efficient portfolio. So that analysis is called as a CAPM. CAPM returns is nothing but a capital asset pricing model. So the formula for CAP return is equal to RF plus beta into RM minus RF. So the difference between RM minus RF is nothing but your risk premium. With the help of the question, easily can we evaluate the return on X limited and the market is given below. Calculate the CAPM return if the risk-free return is 8%. So return on X limited and return on Y, and we have here. So already we know the beta formula into summation xy minus summation x to summation x square minus summation x whole square. So we have to evaluate the summation y, summation x, x square, and xy. So simply we are applying in the formula, we got the summation values 94, 97, 2073, 2015. After applying all the values, we are getting 1.18. Written on market, we know summation x by n. This is summation x by n 16.16. So simply we are applying in the CAPM return RF plus beta into RM minus RF. This is the formula for the CAPM return. The same formula we are going to use. 8 plus 1.12 minus RM is 16.16 minus 8. So we'll get 17.14. So this is a process for your written on CAPM written. Okay. Sorry, I forgot to take the screenshot. Okay. CAPM. Okay. So for your reference also, I'm giving some screenshots. One more problem. CAPM returns with the help of the information stock, 5 stocks information they have given, and betas already calculated beta they have given. So with this, we are going to evaluate the CAPM with the help of average beta. So here number of five number of securities betas they have given. So that's the reason we are evaluating the beta average. 5 years beta divided by 5. So we got average beta is 1. So simply applying in the formula RF plus beta into RF minus RF. RF 8% in the problem they are given beta, we calculate beta 13.5 and 8. So we'll get 13.5% is the CAPM written by using the average beta. Next, with the probability, we'll solve the problem. With the probability, find CAPM return of the securities and portfolio from the details given below. So here condition, 3 conditions are given. Written on A, B, C. So 3 returns they have given for A, B, and C. Next, probability. With probability they have given. So probability 0 0.4, 0 0.4, 0 0.2. Market X we are indicating this way. So we have to evaluate the CAPM. What is the formula for CAPM? RF plus beta into RM minus RF. So for RF in the problem they have given RF 8% they have given. Next, beta. We have to calculate the beta for 3 securities written on market and RF. So that's the reason we are going to calculate the first written on A into probability, AP, B into probability, C into probability, market into probability. So first we have to analyze the probability with the returns on securities, probability with returns on market. This one. Okay. For your information, I'll take the screenshot. Okay. So this is written on markets. Then afterwards, we have to evaluate DA. DA is nothing but A minus A bar, DB, B minus B bar, DC, C minus C bar, DX, X minus X bar. So we have to divide this 30 minus 30 minus A bar is 15.6, B bar, C bar, X bar. So we are going to delete 30 minus this, 15 minus this, and 12 minus this. Like this, we have to get the deviations. So we'll get this all these deviations, dA, dB, dC, and dx. Next, P dx square, P dA into dx, P dB into dx, P dC into dx. All this we need to calculate for evaluation of this CAPM return. After calculating, simply we are going to apply in the formula. Risk on market, market will be indicated with sigma. So risk on market formula is summation PDX square under root. PDX square, we got the PDX square 214. Okay, 214, we are going to get beta. Formula for beta here, based upon the information given in the problem, we are changing the formula. So covariance of XY divided by risk on market square is another formula for the beta coefficient. Next, covariance of XA formula, summation PDX, PDA. These are all the formulas I have given in the previous classes, and I have shared the screenshot also about the formulas. Please go through that screenshot. Okay. Next, covariance of XA, covariance of XC. DX, DA, DX, DB, DX, DC. So we'll get all these covariance. Okay. Next, beta of A, covariance of XY divided by risk on market square. Simply we are applying it. Beta of A beta of B, beta of C. Three securities we have. Okay, so three betas we are going to calculate. This is A beta, B beta, C beta. And simply we are applying the CAPM. RF plus beta into RM minus RF. RF 8%, beta, we got betas of these. So simply we are applying beta of these. Next, written on market. This is a written on market. 16, 16, 16. RF, we know RF 8, 8, 8. So after that, we are going to get all these things. This is CAPM written. By average beta also, we can calculate the CAPM. So we are going to do the average betas of this, average of this. Then simply we are applying in the formula. So we got average beta 5.68. This is the procedure for your CAPM returns with the probability. Next, CML. It is a straight line method considering the most efficient securities an investor is going to purchase to maximize his return with a minimum amount of risk. So this model is always helps the investor to maximize the returns and to minimize the risk. Okay. So here the traditional already existing investors, whatever the existing shares are, securities are there with the things they are going to minimize the risk. So this method is a minimum guarantee risk methods where he will be getting some additional benefits, some additional guaranteed return, which is entirely based upon the risk where the investor is ready to take. So the formula for CML return is RF plus alpha into risk on security X. Just take the screenshot of this. Okay. So we'll calculate the SML. Next, SML. SML is an efficient securities in the portfolio which is chosen by using SML. Here, the relationship between the return and covariance with the market of the security in the portfolio is called as SML. So, same formula we are using for SML like CAPM, RF plus beta into RM minus RF. So, that's the reason we can call CAPM and SML is one and the same formula. So, in the problem, find CAPM and SML return from the details given below. RF is 15% return on security and market has been given. So this is the information for the 6 years, for 8 years, and return on market returns for the 8 years, 12, 10, 12, 16, 10, 14, 16, 6. Y returns, these are the returns, and simply we are going to solve the problem. So first x square we are going to do, x square, this square we are going to do, and we are reflecting here. Next y square here, xy, x into y. Here, it will reflect x into y. Next, dx, nothing but your x minus x bar. So we get all this value. Dx square, simply we are squaring these things. Next, dy, we'll get all this value. And we'll get dy square. Okay, so this is the thing for calculation of your CAPM and CML. So beta formula, n into summation xy minus summation x summation y divided by n into summation x square minus summation x whole square. Okay. So after applying in the formula, we got beta is this. Then return on market x by n, return on security summation y by n. Okay. Risk on market summation dx square by n. Risk on security summation dy square by n. Alpha formula Rn minus Rf divided by risk on market. So we'll calculate. We'll apply all these things in the formula. Please see carefully the formulas. All this formula I have shared with you in the previous classes, and simply we are applying in the formula of CAPM So when we are apply all these values, we'll get the 12.45, the CAPM written, and CML. This is a formula for CML, and 11.74 is the CML. I'll just revise one thing. Please see here. Definitely expected question. See here. Written on market, written on security, x square, xy, dx, dx square, dy, dy square. Okay. Then when we get the value, simply we are applying in the formula. Okay. Fine. Next. Next question. If RF is 8%, find CAPM and CME from the details given. So here 6 years information they have given, 1 to 6 years. Then written on market and securities. Written on market information and written on security information they have given this. Next, with the probability they have given. This formula is without probability. And this is with the probability. So with the probability, these are the values for the with the probabilities. And we are going to calculate first P into X. P into X. So we get all this value Px. P into Y. P into Y. We'll get Py. Okay. Next dx. X minus X bar. Dy. Y minus Y bar. Okay. So Px, Py, dx, P dx square, dy, P dy square, P dx into dy. P dx square. Here you can add one more column dx square, or else only do the square of this and multiply with probability. You'll get P dx square. Okay. So these are all the values we'll get when we'll multiply with the probabilities and with the deviations. Okay. Then after evaluating the values, these are the summations, 5, 3.59, 40.58, 36.30. Simply we are applying in the formula. Risk on market, summation PDX square under root, we got 5.98. Risk on Y, summation PDY square under root, 6.37. Beta formula, covariance of XY divided by risk on market square. So we got 1.101. Covariance of XY formula, this one. Next, CAPM written, formula RF plus beta into RM minus RF, 4.97. Alpha, formula this one. Then we are applying in the CAPM. Just I'll take the screenshot of this. Okay. Please go through with this. Once again, I'll show the problem. This is a question. Okay. After valuing all the values, we are applying in the formula. Okay. Definitely expected question mark. I think no students have joined in the class. So that's the reason I'm explaining once again. Okay. So no student, I'm not wrong. No student has joined. So that's the reason I'm explaining once again. It's arbitrage pricing theory. This is also called as the law of one price. It is an alternative model of CAPM which has been developed by the Stephen Ross. So according to this theorem, the returns on the securities is always influenced by a number of macro factors like growth rate, production, rate of inflation, investment stress, etc. So we are going to use the following formula to evaluate the APT process. So formula is lambda naught plus lambda I beta I. RI is nothing but return on investment, return on zero securities, and risk premium. Two security factors, lambda naught plus lambda I, beta I11 plus beta 2, beta I2. So this is the formula. Arbitrage. Okay. I'll share the notes in the group, ma. A small example. Find equilibrium return of the following securities by using the following two factors model. So this is the question, return on investment 4% plus 4 beta I plus 6% beta I2. Securities beta I1, beta I2. Okay. This is information they have given. So we are going to evaluate equilibrium return of the securities. Return on security lambda naught plus lambda beta I1, beta 2 x2. So by applying all these values in the securities, we'll get A, B, C. 4, 4 lambda 1. And these are the returns which we got beta 1, beta 2 returns. So beta 1 and beta 2 returns we are applying in the formula. And we'll get the equilibrium return of the security. Okay. Please once again go through with the form question. So almost entirely 4 methods have covered. Today 4 methods have covered. Next, dividend capitalization model we are going to learn. Dividend capitalization model. So just go through with this one. There are lots of methods for applying the common stock value analysis. We call as a net asset method or net backing method, or we say inclusive value. This is nothing but the true value, the present values where we have been considering in the market. That's called net asset value method. This may not become for your exam, but to proceed for the dividend capitalization, you need to know about this. And this is the format for your net assets method. Certain assumptions you need to follow. New assets and new liabilities, a given problem must be taken. Asset does not include the fictitious assets. And the formula for the value of each equity share under net asset method is assets available to equity shareholders divided by total number of equity shareholders. And this is a format for this. Assets at the present market price less outstanding liabilities at realizable value. Next, amount due to preference shareholders. Then we'll get the amount will the balance of equity shareholders. So this is the format for the net asset method. For your reference sake, once again I'm showing. Next, book value method. The next is your yield basis method. So this yield basis method is mostly useful for the short-term investors. So we'll adopt it to take the returns from the companies rather than the concentrating on the assets. So this is a formula or the procedure for evaluation of market value based method. So value of each equity shares, DPS divided by NNR into 100. Value of equity shares, rate of dividend by NR into 100 into paid up capital. NR is nothing but your normal rate of return. DPS is dividends per share. DPS, profit after preference share divided by number of equity shareholders. Rate of dividend, profit after preference share dividend divided by equity share capital. Okay. Now this is a format for your yield basis method. Profit, average profit before tax, it is direct income tax, then transfer into reserves, preference share dividend, whatever amount is having tax of equity shareholders. So this is a format for this. Right? Thank you. So here under these methods, whatever the methods which I have explained in the fixed assets, which is going to include both plant and machineries, and we are going to depreciate those fixed assets with the help of some depreciation. And all those depreciation will be considering, and if any kind of appreciation is those appreciations also will be considering. And reserves for doubtful debts, whichever is required for evaluation of the stock, and we can evaluate as per its book value. And liabilities on with discounts also we are going to estimate for this book value method. And the company, it is entering any kind of agreement, also here the machinery price also we are going to consider. With these things, we are going to evaluate the book value method. So entirely it will be dealing with the fixed assets, liabilities, and whatever the amount which is available to the preference shareholders. The formula for this book value method is amount available to the equity shareholders divided by number of equity shares. So there are certain reasons to evaluate these stocks, particular for the companies. So there are various methods which is available to the value of the company shares. Particularly, company is going to follow some kind of shares which is available to the by one of the other company. So the main purpose of these shares is for the amalgamations or any kind of observation. So invested in the long term and short term is going to evaluate these things. So net asset methods or what is the inclusive value method we can consider. So already we have discussed all these things, net assets method and all those things. So for evaluating the EPSS methods, we are having certain pro forma. First, we need to evaluate the value of each equity shares. The value of each equity shares will be evaluated with the help of dividends per share divided by normal rate of return into 100. So dividend per share, what is another formula for the equity shareholders here? The rate of dividends divided by normal rate of return paid up capital also. This is another formula we can evaluate for this. Next, whereas what is the formula for DPS? That is nothing but profit after preferred share divided by number of equity shareholders. And what is the rate of dividends here? Profit after preferred share divided by equity share capital. So this is the thing. So here, what is the format for us? The format is that we are going to be take the average profits of the companies. From that, we are going to deduct the income tax, and after that, we are going to get the profit after tax. When we get the profit after tax, we are going to transfer any kind of reserves there. After evaluating some results of the preferential dividends, the whatever amount which is there in the hands of the equity shareholders, that we consider as a amount which is available to the hands of the equity shareholders. After that, we are going to evaluate all this process. Okay, so hardly most probably 7 to 8 methods we have covered in today's class. Still, by seeing this video, if anyone wants to join, you can join because you are missing lots of things. Lots of methods will be there. If you join, it is better to understand. Okay. Anyways, I'll share the notes, ma. Please go through with that notes. And if any doubts, you can ask me also. Okay. I'll be in the line. Please ask any doubts.